In this video, I'm going to cover how to make a financial model for a startup. A lot of founders are not taught this at all, or if they are, usually it's poorly done. So that's why this video is an in-depth video on how to make a financial model for a startup. Before I jump into the content, I want to mention that there is a template you can download through the link in the description. A huge caveat with this though. Please only download it and use it after attempting to build your own financial model from scratch. If you just try to plug in numbers with it, that will be super frustrating and you'll hate financial modeling more than you might already do. Build your financial model from a blank Excel spreadsheet, yes, Excel, and use the template below as a companion. Don't just plug numbers into it. If you find this video helpful, give it a like, subscribe, and leave a comment if you have any questions. I'll do my best to answer questions in the comment section of this video. Also, I owe some credit to Troy Hennicoff for teaching me how to build a financial model for a startup back in Techstars in 2017, and it's been one of the best workshops I've ever been a part of. So thank you to Troy for teaching a lot of us on this particular subject. Okay, preamble is done. Let's start by laying the groundwork for financial modeling. It's important to understand why building a financial model for your startup is useful. Is not to project what sales you will have 3 years from now to a T. Startups are changing every month, if not every week. So to be able to predict what your startup will look like in 3 years is pretty much impossible. What making a financial model is for is to help you understand your business and how it works. Financial modeling forces you to understand the levers and metrics that matter for your business to go where you want it to go. You don't want to be like I was in my early years of entrepreneurship, where it was just trying all of these different strategies and acting like a loose cannon. There's barely any rhyme or reason to how I went about getting customers, and that resulted in me building ventures that were very inconsistent. Financial modeling helps you not be a loose cannon and truly understand what strategies are working for your business. Another way to think about it is that when engineers design a bridge, they don't just go out there and start building as if all of the materials were Legos and it's just going to magically work out. No, they design it in software and simulate how the bridge will work. Financial modeling for your startup is the same concept. It's testing your startup before you spend a lot of time and resources on it. It's working smarter, not harder. For this example on how to make a financial model for a startup, I'm going to use my Etsy shop as an example. It'll be overly simplistic, but I'll point out where you can make it more complicated. For most, this simplistic financial model will work out pretty well in the early days. The beauty of building a financial model the way that we will is that you can continually develop and iterate on it. It's never truly finished. If you want to learn more about the Etsy shop I started, you can check out the link to it below, and you can check out a previous video of me setting it up with Printify. The last item before we jump into Excel is covering why I'm using Excel and not Google Sheets or any other tool. The reason is that Excel is the standard language of investors, and it's a little easier to save versions of it as you're going to be consistently iterating on your financial model, and you want to be able to look back at previous models from time to time, especially after a major pivot in your startup. Excel is what investors are used to, and it'll make your life a little easier. It's not a hard and fast rule, but it's a very strong guideline. Enough of me just talking to the camera. Let's jump into Excel. And one last time, the template of this financial model is in the description below. So here we are in Excel, and the very first thing we are going to create here in Excel is an assumptions table. Now, this assumptions table is all of the inputs for the financial model. The rest of the tables that we will be creating here in this Excel workbook will be calculated through formulas and from these assumptions. So all of the different numbers that you might be inputting just by typing them will be here in this one table. The rest of them, again, we won't be typing any numbers. They'll be calculated through formulas. To get started, it's really helpful if you just kind of start with all the different assumptions that you might have right now, just off the top of your head. You can even write these down on a whiteboard first to start, or you really just start typing them here in this assumptions table. Now, because we're going to keep this assumptions table really simple for this particular financial model, I'm not going to have a lot of different assumptions, but as you complicate and iterate on this financial model, you'll probably have a whole slew of them as we get going. So here we are to get started. And what you can do, especially if you're going to ever present this financial model, is have your logo in this top row. I'm not going to do this in this example, but that's something you can definitely do. Now I'm going to always label what these tables are here in these like really top 2 rows. So for this one, I'm going to name it assumptions. And the really basic assumptions here and they're really crucial too, is the sale price of things and the cost of goods of things, or COGS. Now, because in this Etsy shop, I can have a whole slew of products being sold, I'm going to keep it really simple and just calculate based off of an average cart size. So for example, let's say that the average sale that I have is for 3 items and they're $20 each. That means the average cart size then would be $60. With that, I'm going to have the average cart size, which is the average revenue we're getting per sale. And then the other number, which is going to be really important, is how much money does it take from a cost of goods standpoint for each of those carts. So I'm going to have an average COGS per cart. Okay. Then the other number, which isn't as crucial as the other 2 numbers, but it's still important, especially if you're doing free shipping, would be just an average shipping cost. Okay. So those are 3 really basic numbers. Let's jump into more of the sales funnel of this Etsy shop. And I'm going to think of this sales funnel first, starting with the top of the funnel. And for the top of the funnel, I want to think through 2 different strategies. One is a search engine optimization strategy, or an SEO strategy. And the other one will be a paid ad strategy. Essentially, maybe we're buying Facebook ads or buying just really ads anywhere. So for SEO, what I'm going to do is just have it as blog posts per month, and then average traffic per blog post. And then because SEO kind of grows as you are posting more and your domain is ranking higher, I'm also going to have a SEO growth rate. Okay, so that's the SEO. And SEO in this part of it, and we'll do this the same thing with the paid ads, is that this will just be really calculating how much traffic is coming to the website. This will make more sense in just a moment when we get into the traffic detail tab, but that's all we're doing with this SEO. We're just calculating the top of this funnel. Okay, now for paid ads, what I would do is let's say for this example, we'll do our monthly ad budget, and then let's do a cost per visit. I know it's not the technical term, but just trying to keep things simple. So those are the really 2 big things. So for example, let's say our budget is $1,000, and to get a website visit from the ad budget, it's $1 per visit. So if we have $1,000 as our budget, we would expect 1,000 visits to our website. The other thing, which is I think important, because direct traffic really starts growing, and it's just direct. It's kind of just this thing that's just growing. You don't necessarily know where people are coming from all the time, but because direct traffic is just people putting your website into the browser. And as your business is growing, that number will grow as well. So I'm going to have a direct traffic multiplier. And this will just be growing that direct traffic as the business is growing, especially with SEO and this monthly ad budget, creating more credibility, more people come to your website as time goes on. Okay, so with that, we really have our top of the funnel figured out. We have this, these different sale prices and the cost of goods. The next thing is really just a conversion rate. Now, this is one of those things that you could get really tricky and really complicated and iterate on this in the future. Because what you could do in some fashion is actually have a conversion rate for each of these different types of traffic. So you could have a different conversion rate for a blog post or for SEO. You could have a different conversion rate for ad budget, and you could even have a conversion rate for direct traffic. Those will all have different conversion rates because the way they're getting traffic is a little bit different, and that quality of traffic is definitely different for all 3 of those. And it depends on the business and how good those conversion rates are. And that is something that you can actually measure through Google Analytics, or really a lot of the different analytic platforms that you might be using to measure your website analytics on your website. So, but in this case, we're keeping it really simple. I'm just doing a conversion rate from visit to sale. Super, super simple. Okay. So you can see, here's this is the top of the funnel, like all the number of visits coming to your website. And then this is, essentially closing out that funnel. Who is coming from that website, and then who is actually converting from that. And then if we measure from that, then we can calculate and multiply by these numbers here. Then we can actually calculate how much revenue we're doing per month, the costs and things like that. So The very basic revenue now, financial model, really this like the more like napkin sketch financial model is actually all right here and just these a few assumptions. Again, it's super simple and you can complicate this as much as you want, but we're just keeping it simple for this example. Okay. The other thing I'm going to add, which isn't as crucial because costs are something you can always change and edit, and they're much more easier to figure out as compared to revenue. Really, the way you want to spend where you want to spend your time in this financial model is on the revenue side in this sales funnel, like we've been talking about. Because if you can help predict and really understand how much revenue and how you can get revenue, the rest of it kind of figures itself out. It's way easier to manage the cost of your business than it is to increase your revenue or do those things, because revenue is customer based. There's a lot of people involved, a lot more complications with it compared to the cost, which you have really most of the control over. Now for the main cost, it's really going to be just like employees and just like overhead and those different things. These are really your indirect costs. So what I'm going to do is your taxes and benefits, rent per employee per month. I'm going to do office expenses if you have any employees. In this case, we'll just assume we do. We'll have legal and accounting fees per month. We'll do personal development too. Training budget per month. If you're going to be recruiting staff, that's definitely important too. So I'll have a recruiting budget per month. And if you're going to be traveling in any, maybe going to conferences or whatever, traveling to customers, we'll have a traveling budget too. For an Etsy shop, there's probably not much to it, if any, but we'll just throw it in there just so you can see what it's like. The other thing you can also do is add in a product development budget. So what you could do is like product development based on revenue if you want. Product development budget, percentage maybe. There's definitely different ways to do this, but for this example, I'll just do a percentage to keep it simple. Okay, so the last thing I want to add in, and this is really related to the number of sales, would be if you have returns. So this would, if you're doing a software as a service company, this would be like your churn rate. Now so I will just do a return rate percentage, and this will be like just decreasing from your revenue, which sucks. But this number can be really crucial, and this can like make or break your business. So that's why I'm going to include it. If you're an Etsy shop, you probably don't even like accept returns, probably, especially if you're doing custom things. But if you're not an Etsy shop, or if you're most businesses, you're going to have a return rate. So that's why I'm going to include it here. Now that we've named the assumptions, let's actually just put some like more placeholder numbers in all of these different assumptions here on the right side of them in this B column. Before we put the numbers in them, though, this is kind of just an Excel trick that's really helpful for financial modeling, and that is to just hit this. If you go to this B4, you can actually rename it. So what I'll do is do average cart size. Now, this might not make any sense of why this is helpful later on, but as we're building out formulas, instead of having to continually click back to the assumptions table and whatnot, if you can just type in, average cart size really quickly, it saves you a ton of time for building out this financial model. Okay, so we have average cart size labeled, then we'll do average costs, average COGS. You can't do any spaces, so we'll do that. And then we'll do average shipping. And the other thing to keep in mind is that you can't put it, if you have a number in here, it doesn't allow you to relabel the cell. So that's why I don't have the numbers in there just yet. So there's that. So blogs per month. Then I'll do average traffic, blog. We'll do the SEO growth, monthly ad. Let's do CPV, DTM. Hopefully I remember what these acronyms are. Con rate, visit to sale. Taxes and benefits. We'll do rent employee. We'll do office expense, legal and account, training budget, recruiting, monthly, travel, monthly, product dev budget and return rate. Okay, so now all those cells are named. So let's actually just, what I'm going to do, just kind of highlight these as green numbers. So I'll just do this. Oops, wrong thing. You should use the bucket. So you can see there. And this, I like to do this because it tells me that these are the inputted numbers. So I know which cells are there and which cells are editable and which ones aren't. So there's that. All right, so all of the cells now are colored and their names. Now we can put actual like just numbers in them. I'm gonna just put just kind of some more placeholder numbers. The nice thing about having, again, like this assumptions type of table is that you can iterate and change these numbers as you go on. So let's say your average cart size goes from $60 to $100. Well, you can just change it here in this assumptions table and the whole financial model updates. It can tell you a lot of different things. You can play around with it and see how your financial model, changes as you change these numbers. So we'll do that at the very end so you can see how it is really impactful and helpful. So for average cart size, I'm going to put it as $100 just to kind of have some fun with it. Okay, I changed the text here. I'll do $100. And the other thing you want to do is make sure you have the right formatting too. It's really helpful just to kind of keep it organized. Average cost we'll do as, let's say it's $50. So there's 50, and average shipping, let's say it's $15. Blocks per month, we'll say we're doing a blog per week, so we'll do 4, keep it simple. And average traffic per blog post, let's say it's 500 visits over time. Actually, and this one's just a number, so we'll just do that. And so is this one. And then SEO growth rate, let's say that's 10%. I'm not sure what it actually would be, so I'll just keep it as that. Monthly ad budget, let's just say it's $1,000. And then cost per visit, let's say it's $1. Keep it really simple again. Direct traffic, let's just do 10%. And these are numbers that we can change later. So I'm just kind of putting numbers as placeholders so we can kind of just see how everything calculates really nicely. And conversion rate from visit to sale, let's say that's 3%. So 3% of the traffic coming to our website is purchasing, which would be pretty good. Then taxes and benefits. So this would be 25% of their salary, most likely. So I'll just do that as a percentage. And then rent per employee per month. Let's say that's $300. We get like a WeWork space or whatever it might be. Then I'll do this. We'll do money. Office expenses per month. We'll say it's $100 for them. Might not be. Legal and accounting fees per month per employee. Or he doesn't have to be employee, but it probably will be. Legal and accounting fees per month. Let's say they're just, $300 to be safe. For training budget, let's say it's $300 as well. For recruiting budget, maybe it's $500. And travel cost per month, let's say that's $500 as well. We're, again, just guessing. So there's these two. Set them as currency. And let's do 10% of our budget towards product development. We don't want 1,000. And the return rate, let's say that's about 10% as well. Okay, so we now have all of our assumptions, at least the assumptions we're going to start out with, and we can always add or edit or delete these as we move forward. The last thing we want to do is just name this sheet to be assumptions. So that way we know which sheet it is and we don't have all these random sheets and we're staying organized. So, okay, we have assumptions now created. Let's move into the traffic detail table. And I'm going to name the sheet right here, traffic detail. And all traffic detail is the amount of traffic coming to our website. So it's pretty simple. And we're going to look at this as a monthly basis. And the first thing we'll do is do the month. So what we'll do here is just hit month. And we'll say this is January of 2023. Now you can see here the formatting is a little strange. And we want to fix that. So what we'll do is go to format it. We'll go to format the cell here. Format cells. And what I wanted to do is just do the month and the year. So you can see here it is. Hit OK. And there you go. You can see it's saying thinks it's January 23, but I'm just gonna hit this, and now we're good. The day doesn't, whoops, the day doesn't matter too much because we're not reading it. And we're not calculating based on anything on that. So it doesn't matter too much about what day this actually is. Okay. Then instead of typing every single date there, here, and every single cell here, the nice thing about Excel is there's all these different formulas. So what I'll do is called eDate, which is the start date, which will be this. And what we're going to do is just add a month. All eDate does is add time and months to it. So it does that. And you can see here, it's not formatted very well. So what we want to do is actually format this entire row. So I'll go to, again, format the cells, and we'll go to date, and we'll go to the month and the day, or month and the year. So let's find that. I think this is the right one. Yep. So you can see here, now it's formatted right. Now, the nice thing about these formulas is that they are smart. So if I just click and drag, so if I click this, grab this, and then drag, you can see it's going all the way to January 26th, which is awesome. Now you can see here is all these different, it's too big of a format. So actually, if you just click over, it'll take rid of it. If you double click on this, it'll take care of it. So I'll just do this really quickly. And now we are good. I know there's little tricks that do fix this faster, but it's not that big of a deal. Okay. So we have all our months there now. Now let's actually create the traffic detail per month. So the first thing we're going to start with is SEO. Now, again, we're going to be using these assumptions that we have here to build the traffic. And we're talking about the top of the funnel. That's what really this traffic detail is. All it's telling us is how much traffic is coming to our website, and we'll use this traffic then to actually build the financial parts of it. So for SEO, what I'm going to type in here is this SEO traffic. And what it's going to be is that there's going to be this January date. And what I want to hit is equals blog post per month times, which is this little, like if you do shift 8, where you get the little star, times the average traffic per blog, right? So that's going to tell us how much traffic is coming in that first month, which is 2,000 visits. If we do 4 posts, that might not be accurate, but for now we're just going to roll with it. So that's the initial calculation. Now, how do we do this for the rest of the months? So what we'll do actually is hit equals, and we're going to take this traffic that was in the previous month, and we're going to times that by that growth rate. So to do that, this is the orders of operations. If you remember this from elementary school, it's really important. So we'll do the cell times SEO growth plus, again, essentially that same formula that we did. So it'll be the average traffic per blog times the average blog post per month. So you can see here, this isn't the number we were expecting. And that's because you can see here, really what we're doing in C3 times the SEO growth is all it's doing is multiplying that 10% times this 2,000, which is 200 visits. And that's why we have 200 extra visits. But really what we want is this visits to be adding to this. So what we'll do is hit 1, and we'll add 1 to the growth rate. So we'll do a parenthesis, 1 plus, and then we'll add another parenthesis. And there you go. Now it's fixed, and that's the number we would expect from this calculation. Now with this, the nice thing here is that now we can just click and drag like we did with the months. So we'll click and drag all the way to January 26th. And you can see here, here's all those numbers, and the visits get really mad and crazy. So if you want to get more complicated, you can see here, there's all these decimal points, which is a little bit strange because you can't have 0.95382 of a visitor. You can only have either one visitor or just the whole numbers of integers. It's not that important in these basic simple model, but there are formulas and ways to format it here in Excel. I'm not going to cover that because it's not that important, but if you like to, you can. But what I will do is actually just use this number here, or just to get rid of these decimals. So what I'll do, just kind of get rid of them so we have whole numbers. At least the way it looks like. It looks like we have whole numbers. If you do calculations with them, it does add in the decimals, but they're not going to change this financial model drastically, and we're not trying to be fully exact. We're just trying to understand how this business works. That's why it's not as important. split comma, and then you can see here it does add it again, but we'll just get rid of them. And there you go. Now you can see how many visits are coming to the website just from purely SEO. Okay, so that's SEO traffic. Now let's do the paid ads. So there's paid ads, and this one is, right, so we have our monthly budget, ad budget. Whoops. So we'll do our monthly ad budget, which I'll click here, and then multiply that by that CPV value. You can see here, because of I'm naming things, it's really easy just for me to type it in and it brings it up really quickly. It's a big time saver. So at that, and you can see here, there's 1,000 people coming in. Now, we could do, right, we can just have this be consistent throughout the entire thing. But what I want to do is actually have a growth rate with this. So what we'll go back into is actually go back to assumptions, and we're going to create a growth rate in there. So what I'm going to do is just hit insert here, just so we get another space. I'm going to do add growth rate. So I'll do this, I'll rename it, add growth. And for this, to keep it simple, I'll color it, and I'll just do is maybe 10%. Again, these are just placeholders. We don't have to be exact right now. Okay, so we have that. And so that'll be our first number. But then similar to like SEO, what we'll do is do equals this times that growth rate, which is that 1 plus ad growth. And then what we'll do is that same calculation that we just did, which is adding the monthly ad spend, ad budget times the CPV. Okay. And that should do it. So yeah, you can see here, that's the number we were expecting. So you always want to check which number you are expecting, because sometimes Excel, and especially these formulas, get a little wonky, especially if you're getting more complicated. Definitely check your numbers and make sure you're just doing maybe even just, calculation off your phone with it. That's really, really helpful. Or even what you can do too is do parts of the formulas in different cells and then bring it all together at once, because these formulas can get really wonky and really complicated really quickly. So now that we have that though, let's actually use this and drag it all over again, just like we did in these previous examples. So we'll drag it over. We have all these decimals. We'll do that. And there you go. There's all the visits we have from paid ads. So now that we have SEO traffic and paid ads figured out, what we want to do is just total all of these numbers, because we're going to use that total for our direct traffic growth rate. So I'll do SEO and ad traffic together. And it's pretty simple. You just do equals this plus this. Pretty simple. And we can just drag that all the way across, and then we're done. And I'm actually going to bold that so I know what, like, that's just kind of a organizational thing. You don't definitely don't have to do that, but I think for me, it helps me keep it organized. And then the next thing I'll do is do a direct traffic calculation. So what we'll do, it's pretty simple here, is actually just take equals this times our direct traffic number, which is, I think, the direct traffic multiplier, the DTM we did. Yep. And so you can see there's what we would expect our direct traffic to be. And because this is calculating off of this, we don't need to add a growth rate or anything like that. All we have to do is just click and drag, because like growth rates are built into the paid ads and the SEO pieces of it. So there's that. And you can see there's all the direct traffic we would expect. All right, so there is direct traffic. And then what I will do is just create a total traffic number, which is just going to be this. And I'll do equals this number plus our direct traffic. So let's click and drag again. Okay, now what I will do is really just highlight this. Well, I'll bold it. And you can color this. I think I'm going to just make it simple in this case. You don't have to do this. But that way, like, we know that that's the number, like the really important number of who's coming to our website in total. All right. So we're not going to worry too much about these numbers, whether they're realistic or not. Right now, we're just going to matter of like, are these calculations right? And can we continue building forward with the financial model pieces of it? And I think so. We have the top of the funnel really calculated at this point, right? We've done SEO, we've done the paid ads, we have the direct traffic. So we have our big traffic sources. and we have a total traffic number. And that's what we need to move on to this next part, which is the monthly income statement. Okay, so to start with the monthly income statement, we'll do is create another tab, another table, and we'll type in monthly income statement. Now, what the monthly income statement is telling you is really just like how well is your business doing. This isn't telling you how much cash is in your bank or anything like that. The monthly cash flow statement will tell you how much money is in the bank. So if you're someone that's never financial modeled, you'll be like, why is the income statement and the bank account match? Is because that monthly income statement is just telling you how well your business is doing on a monthly basis. But it's not calculating how much money is actually coming through to your bank account, especially if you've had money in your bank account already and maybe you're fundraising or anything like that. That's where monthly income statement and cash flow statements are different. So monthly income statement, we'll type in here, monthly income statement. And just like we've done with the traffic detail, we will do this on a monthly basis. So I'll type in month here. And this is just like we did previously. So we'll do January 23. I'll do January 1, Jan 1, 23. Okay. And then I'll go to format the cell, the date, and I actually want to do this. Actually, I'm going to cancel this because I want this to be on the bottom of it. So I'll do January 1, 2023. So you can see it formatted it. And to format the entire row, I'll just select all of it by clicking there. I'll do format the cells, the date, and I want it to show me the month and the year. So I'll do that. Bam, you can see there, it says January of 23. And then similarly, we'll use the eDate formula. eDate, this one, only 1 month. Because I added an extra parenthesis. Whoops. So there's that. So we're good there. And then we'll click and drag all the way to January 26th. All right, too much. All right. So I'll double click. This is more just because I like it to be clean. So click there. Okay, so everything's clicked through. And all the Excel people are kind of cringing because I'm not doing all the shortcuts and whatnot, but that's not what this is for. Okay, so I'll bold this so it stays out there. Okay, and the first thing we want to start with is revenue. So I'm going to type revenue so it's just kind of clear. And we kept revenue really simple. We're not doing, you could do like each individual product if you want, but we kept it in this example just the average cart size. So I'll do the average number of sales or average sales. Now, here's where things are a little bit interesting, or at least it's a really important thing to note. This income statement is all dollars. It's not the traffic. It's none of that. It's all dollars. It's all the same type of data. So that's why we've separated traffic detail and the monthly income statement, because traffic is a different type of data. It's traffic data. It's not money. Monthly income statement is all cash. So it keeps things organized and cleaner with different types of data separated. You could, right, in theory, put everything together in one workbook or one table, but it's way too complicated. If you're ever presenting it, it's even more complicated. So keep different types of data separated. If you ever seen me talk about Airtable and the different types of data, this is a very similar concept. So what I'm going to do here is do the average sale. So revenue, I'm actually going to add another row here or another column. So I'll do insert. And what I wanted to do is actually just kind of move this one over. To get started with this revenue section, it's actually going to be pretty easy. What I'm going to put here is do revenue per month. And we've done the hard part for this calculation because the way we've set it up and the assumptions pieces of it, we have all that traffic, which we just calculated in the traffic detail. And we have a simple conversion rate from traffic to customer. So we'll use that. We'll multiply that from the traffic. We'll multiply that conversion rate times the amount of traffic that's coming. And that'll give us the number of customers that we expect. Now, that's not a dollar sign yet. So to get that, what we need is the amount of revenue per customer. And in this case, that number is the average cart size. So what we'll do is we will do equals the average cart size, multiply that by the conversion rate that we have, which is this con rate V to S. And then we'll multiply that by the traffic detail that we just calculated. So I'll go back to traffic detail. I'll select this. And this is important to notice here. So if you're kind of new to Excel, you want to make sure this says traffic detail and not monthly income statement. Because if it doesn't say traffic detail, it's going to grab it from the monthly income statement, which isn't the right cell you want it to pull from. So just make sure if it goes to 0, you know why. Now with that, we have this calc formula. So I'm going to hit enter, and you'll see here, that's the amount of revenue we expect in that January of 23. So that's pretty clever and pretty nice. Now, the nice thing about Excel is that now that we have this formula and we have all that traffic calculated with all the growth rates and everything else, all we have to do now is actually just drag it over to the rest of the month. So I'm going to do that. I'll drag it over. You can see these numbers get pretty lofty, which is, again, we just have more placeholder numbers. So, but at least gives you an idea of how fast and how things can change really drastically. Now, the other thing I'm going to do is hit currency here. You can see Excel formats that all really nicely. Okay, so we have the revenue numbers there, and we're pretty much done with revenue because we've really simplified it. Again, you could get more complicated with having all the different products and the different conversion rates, and you just keep adding in this section if you wanted to. That makes it more customizable. You get a little more granular, and that's definitely helpful. And if you're definitely at that stage, definitely do it. But if you're just getting started, just do an average revenue number and go from there. Now that we have revenue calculated, now it's pretty much the easier part, which is managing and calculating all of the different costs. The revenue definitely, especially if you get it more complicated, is the hardest part of it. So if you're going to spend time on any part of this financial model, it's on the revenue part of it. You can really spend 80% of your time just on the revenue part of this financial model. Okay, let's start with the cost though. Let's start with the direct costs. And the direct costs are just what are the direct costs essentially, or the costs that you absolutely need to spend when someone purchases from you. So in our case, those are just the cost of goods that we have, which is that cost of goods that we calculated and used it as an assumption earlier. So I have cost of goods per month. And this calculation for us is actually pretty simple because it's essentially just the same revenue per number here, except instead of using this average cart size, we're going to be using the average cost of goods. So actually what I can do is actually just copy and paste it. So I'll do copy, and actually to make it a little bit simpler, I'm just going to copy this part of it. So I'll do copy, and then I'll escape. And what I wanted to do is do this, and then you can see, I'll just go back into here in this upper part of it and do average costs. And there we go. You can see there's the average cost number. And just like we've done with a bunch of different examples at this point, we'll just scroll all the way over. Okay, so now I have that, and then I'll do this money sign. And you can see there's our cost of goods per month. Okay, so that's pretty simple. Now, here's kind of the fun part is you can see how much gross profit you have, and this is before any other more indirect costs. So I'll do gross profit, and I'll do total gross profit. And all it is this number subtracting this number. Pretty simple calculation. So I'll do that. And there you go. There's our gross profit before we do all the indirect costs. All right. Now what I'm going to put in is the marketing costs. And these are pretty simple just based on the assumptions that we have from earlier. So from us, we just have the ad spend really. So what we'll do is do monthly ad spend. And this is pretty simple. So it just equals that monthly ad budget. That's the whole thing. It's really, really simple in this financial model. So I'll click and drag that all the way over. Now, what you could do in this ad spend is actually as you're getting more customers, and in theory, right, you don't have to necessarily put your ad spend in because if you're doing maybe a percentage of your sales, you can just calculate it based off of that. And also your ad spend is probably going to be more dynamic than just putting like, hey, we're doing $1,000 a month. So what you can do is actually just do as a percentage of your sales, kind of like what we'll do for product development in just a moment. Now, what I want to do is actually just format this as a number. So I'll just kind of do this, do that. So now we have that. Okay, so there's all the marketing cost. Now, we don't have to do a total marketing cost. If you had like maybe an SEO budget, an ad spend, maybe a content budget, whatever it might be, a trade show budget, you could just add all those different categories up and do it that way. We only have one spend, so we're just gonna keep it like that. Let's move on to indirect costs. And these indirect costs are really like the operational side of things. And you have much more fine control over these indirect costs comparatively to how much revenue is coming in every month and so forth. So indirect costs, things would be like salaries, office rent, office expenses, product development, legal and accounting, travel, recruiting, and those are like the basic buckets that we're going to be focused on in this section. So for salaries, we're not going to do that one just yet. Office rent, we're not going to do that one just yet. And office expenses, we're not going to do yet. But we are going to do product development. And product development, the way we set it up in the assumptions is that it's a percentage of our revenue. So what I'm going to, it's a pretty simple calculation. And what I'm going to do is hit equal here. And I have the product dev budget, which is going to be a percentage. I think it's 10% right now. And if I multiply that by the amount of revenue, so if I do this and then set this to equal this. So you can see it's a pretty simple calculation, which means we're going to spend about $1,000 if we have that much revenue. And there's nothing more to do. So I'm just going to stretch it out. And we now have our product development budget all set. So that's all good to go. Legal, accounting, travel, and recruiting. These are all, and these ones as well, salaries, office rent, and whatnot. These are all really dependent on how big your staff is. So the thing that we want to jump into now is the employees tab. So we're going to put a pause on the monthly income statement and go to and create an employees tab. So I'll create a new sheet. For this employees tab, what it's doing is it's essentially helping you create your org chart, at least trying to predict what your org chart is and the costs that come with that. So we have the employees here that I've named it, and I'll do the month just like we've been doing with everything else. Now, we have this as a different table because this is a different type of data. So you can see where we've done traffic detail, which is traffic on the website. We've had the monthly income statement, which is all the cash, and then employees, which is, people numbers. So these are all different types of data, and we're keeping them separate and organized so that way this makes sense, it's memorable, and things don't get too chaotic. So we have the month, and what I'm going to do, just like we've been doing, is 1/1/23. And then we'll have to change the formatting again here. So I'll do this just like we've been doing. I'll go to date. I'll change it to this. Okay. And then just like we've been, again, we'll use the e-date, this one, and we're good to go there. And then I will stretch this all the way out to January of 26. Oops. All right, so we're at January 26th. So I'll clean this up really quickly. Okay, so I'm only going to do 2 roles, and one is going to be like the founder, which is probably going to be you, and let's say just like a logistics person. Now, what you want to do here is, so these are just going to be the head count, essentially. How many people are going to be in that particular role? Well, for this, what I'm going to do is put 1 because I'm going to be on this, and it's just going to be 1 the entire time. So I'm going to stretch that out. And you can see you're probably like, oh my gosh, he said we're not going to actually input numbers here. This table, we are going to make an exception for. So do type numbers in this table, but the rest of it, do not type numbers into it. Use the assumptions and do those things. Because if we put all these things as assumptions, the assumption table gets really messy really quickly, and we don't want that. We want to keep our tables clean, organized, so that way as we get more complicated, it doesn't become this disorganized mess. So this employees tab is definitely an exception to just inputting numbers and whatnot. Then for logistics, let's say we think we're going to need one, or at least starting part-time in October of 23. So I'll do half there. And let's say they're part-time all the way until May, and then become full-time. So that's 1, and then we'll just keep that as 1. And then maybe by the 25th here, we need another one. So we add a second employee there. So again, these are just headcounts and number of people that we need in these roles. Now that we have the people and their roles, let's actually go into what they're going to be making salary-wise each month. So what you can do here is what I like to do is just put their annual salary here. So let's say I want to pay myself $60,000, and we'll pay our logistics person the same amount. So you can put their founder, and again, the logistics person. And you can create these different titles, whatever you might be. And you can create a whole bunch of roles, but again, we're keeping this one pretty simple. And how to do this is actually just take this number and divide it by 12 because there's 12 months. So there's that. And then I'm just going to drag this all the way out. So you can see here, I actually shouldn't have done that because what it's doing is that this value, this A7, what it's doing is it's grabbing, so like this number is actually grabbing this founder value. And then this 417 is grabbing the $5,000 value. That's why we're getting numbers every other one. So to fix that, what we need to do is just do a $sign for each before the cell, because that way it keeps it at the same one. So what will happen, so this one will stay the same now. And then now if I drag it, it'll be fixed. And now you can see it's $5,000, what we were expecting. What you could do in here too is kind of do expected bonuses and raises if you want. I'm not going to put those in, but you definitely could do that in your assumptions tab and have them built out in this financial model as well. So I'm going to do the same for this, and I'm going to use the $signs again and divide it by 12. Okay, so that's what we have. And so you can see here, it's kind of wonky. Now, here's the thing. We don't actually want this to be the calculation because we don't have necessarily someone in logistics right now, right? It's at 0. So to fix this, what we need to do actually is multiply this by the headcount. So if I do this, I'll just to keep it clean, what I'll do is do this times 1 and then times this cell. So now this number will stay the same because it's 1 throughout. But if I do it for this one, what it's going to do is actually change based on the head count, which is really nice. So multiply that by that. So you can see it went down to 0. And then, bam, you can see here the numbers changing. So we went up to, now we went up to 2. You can see it went down up to 10,000. And then you can see here's the part-time and whatnot. So as you're changing these numbers, the salary count is going to change as well. Okay, so that's like the basic salary numbers, but if you've ever hired anyone or been hired, you know there's actually some like overhead, there's the total payroll, there's healthcare, there's benefits, there's a whole slew of things. So that's why we have that benefits assumption. So if you go to total payroll, or we're going to create a total, so we're going to create a total payroll row here. So it'll be total payroll. And it's just going to be the sum of everything. So it's going to be the sum. I'm going to use the sum function. So if that way, if you want to add other employees, you can. It's a little bit easier than just adding every number. Then that, and then I will just drag this across as like we happen. Okay, so we have the sum of the salaries. And then here we want to calculate the benefits and taxes that go along with it. So this would be taxes and benefits. And this is nice because all we have to do is hit equals. This will be the taxes T and B like we have in the assumptions. So you can see here it didn't actually do that. So you can see we'll do T and B and we'll multiply that by this total payroll. So that is the taxes and benefits in total. That's not adding the payroll to it. It's just what we're going to be paying on top of all that payroll. So I'm going to drag and drop all of that, or just drag it over. And then for the total, with total payroll with benefits with T and B, which will be this sum. So there we go. So there is our sum of taxes and payroll. Okay. So that's really helpful. And the other thing I'm going to add here too is the total headcount. So just do total, and I'm just going to just do a sum of these two. And this will make more sense of why this is important in just a moment. We move back to the income statement. Okay, so we have our headcount and we have that calculated. We have all the total payrolls figured out. So this would be the employees tab. And this is really helpful, or like just to kind of see what is a priority in terms of your hiring. Because if you're having, let's say, if you're doing really well in a B2C company, you want to have customer service agents or backend to help you out. It also can kind of help you think through, okay, when do we need to hire so-and-so, or maybe we need to get a contractor or a service provider to help us out in certain areas. So This is a helpful exercise. It doesn't have to be exact, but it definitely is a helpful, like the rest of this financial model, it's helpful to kind of think it through and where people might land and when you can hire certain people. So now that we have this employees tab built out, let's go back to monthly income statement. Now that we're back in income statement, let's input the salaries because we have that. And these salaries will be the salaries with the taxes and benefits. So I'll hit equals and I'll go back to employees and I'll do this number right here. And all you gotta do is click on that and hit enter. And there we go. We are all set up. So then I'll click and drag because it's the nice thing about Excel is it's smart enough to know just to go across the rest of it. Okay, so salaries is in there. Office rent. Now, the way we've done office rent, if you go back to assumptions here, you can see we have, these are per month and these are per employee. So to do this calculation, we have to use that headcount number that we just calculated in the employees tab. So this headcount number needs to be multiplying these assumptions and based on the headcount. So if we go back to monthly income statement for office, what it's going to do is we'll hit go to equal. We'll go to rent per employee, times the total headcount. And there we go. So you can see this $300. We'll drag that over. And you can see the rent is changing as the employee headcount grows. Okay, so there's that. And then we also want to change this into a money sign as well. Keeping our formatting just simple and consistent, that's really important. Because it's really easy for this to spiral out of control really quickly. So make sure you're getting these little details and not just being lazy of being like, oh, I don't need to do that. I think it's really helpful and keeps things organized and make sure that things don't get messy in the long run. So office expenses are really similar to office rent. We have a per employee on that piece. So if I do office expenses times the headcount again, hit enter, you can see here we have $100. And we will drag that over again. And then do the dollar sign. Legal accounting is pretty much the same deal. So legal and accounting, we'll do, So legal and accounting, we will do the legal and accounting times the headcount again. Employee C5 and drag this over. And there we go. We hit dollars. We got that. Travel is the same thing. Now, what you could do to help shorten this up, you could just copy the formula like we did earlier in this video, if you wanted, and actually just change the different variable, the assumption number. But so there's a couple ways you can do it. However you prefer, I think is the best way to go. So for now, I'm just going to click over. Well, actually, I messed it all up. So I'm going to do this. I'll do it over again. So it equals travel monthly times this headcount again. And we'll move it all the way over. And then we also want to do that. And recruiting will be the same. Okay, so there's that. Times that. All right, so with all of that, we now have all of our total indirect costs. So what I'm going to do is create a total number here. And I'm just going to sum it. Sum all of these. Bam. And you can see the nice thing, because we're formatting all of these, this is already pre-formatted. So it's really nice when you do things like that. And it's when you're putting in the work on these little things, it helps in the long run. And that's an example of it. Okay, so I'm going to bold this too, so that way total indirect cost. I'm going to bold this so this is really obvious, and because this is a really key number. I'm also going to bold this one as well, the gross profit. That's not the right thing I wanted to do. I'm going to bold it here. We now have the majority of our monthly income statement built out, but there's just a few more things we need to do, and they're really simple. The first thing, which is actually probably the most important thing, is the EBITDA. And this is estimated earnings before taxes. It doesn't really matter. Just know this is kind of like the amount of money, the profitability of your company month over month. So for this is what we have to do is just take all that revenue that we have. So the revenue, and there's a few different ways you can do this. You can take the gross profit and because this is already calculating the difference between these two. So actually I'll do that. So I'll do equals gross profit minus our ad spend minus our total indirect costs. So you can see here, because it has the parentheses, we're actually running at a deficit. So, but the nice thing is with this formula, we can kind of see when we maybe turn profitable. So we'll do this, we'll move it over. You can see that just the month-to-month basis, we actually get to a profitable, we're running at a good rate. So we're only running in the negative for 2 months and with all these assumptions. Again, a lot of these numbers are just placeholders, and we'll play around with them in just a moment. Okay, so the EBITDA is there, and that's really cool to have, and that's really the end of creating a monthly income statement. So we now have our monthly income statement completed. This is a very basic monthly income statement, but it works out, and you can tell how well you're doing each month over month. The one thing though it's not telling us is how much cash is actually in the bank, and do we actually have the money to cover these losses in these particular months. So to do that and see that, that's why we create a monthly cash flow statement. So that's what we're going to create next, is a monthly cash flow statement. So we're going to create a new sheet and call it monthly cash flow statement. Now I'm going to go up here and do the same thing. So I'll do monthly cash flow statement. Drag this over a little bit and then do month. And do the same thing we've been doing with the months. So we'll do 1/1/23. And then we'll change the format to the date and just the month and the year. And then we'll do eDate, parenthesis, this, and 1. We'll change this if I can type. All right. And then drag this over. All right, we'll only drag it to January 26th like we've been doing to be consistent. So we've done this. Okay, so cash flow statements are pretty standardized, so we're going to keep it pretty standardized also in this. So what we're going to do is we'll have a beginning cash balance. We'll have our cash receipts, and these are just essentially our revenue, is what's coming in the door. So it'll be gross sales for us. And then it'll be total receipts here. Okay, and then disbursements would be the expenses, essentially. You can think of them as. So that would be gross expenses, like which we just calculated in the monthly income statement. Amortization and depreciation. This isn't as important. You can do this, but it's not necessarily a necessity to do out of the gate. I actually most of the time just kind of forget about it because it's not as important. The other thing that's not as important in these early days is income tax paid, because if you're running at a loss as a startup, you're not going to have too much taxes paid. So these two, don't have to worry about too much, the amortization and depreciation. This is more important if you have maybe some larger assets. So let's say maybe you bought a tooling, if you have a hardware company and you have tooling like for molds and whatnot. Those things are going to depreciate. I mean, that's a good asset. Anything that's maybe a large asset and you want to calculate that, you can. But for most companies, you don't have to worry too much about these, especially in those super early days. They're not very crucial. But I would say, again, spend your time figuring out how you're going to get your revenue, understand how your revenue is coming in. But then we're going to do a total disbursements here. And then a net cash flow from operations. The last thing we're going to add to this monthly cash flow statement is financings. So this would be if you're raising money or maybe you want some grants. That's what we're going to put here. So this would be financings. So we're going to do maybe long-term borrowing, long-term repayments, short-term repayments. So maybe you take like a little micro loan or whatever it might be, and equity or in grants maybe. And then we'll do ending cash balance. Okay, so just so everyone knows, so this beginning cash balance is what is your bank account at the very beginning of the month. And this ending cash balance is what your bank account is at the very end of the month. So you can think of it as this is January 1, this is January 31st. So and everything, all the cost, all the revenue is happening in this middle section. So It's really nice to have just a quick look, and because cash flow statements are pretty simple to look at least the way we're creating them, they're pretty easy, and you can see really quickly how much is in the bank account. Do we need to fundraise? What do we need to do to make sure there's money in the account? Because if the money goes to zero in this cash flow statement, that's a big problem. Now, one thing I'm going to add to the assumptions, and you can see here, this is why it's nice to have this assumptions tab, is a beginning cash balance. Let's say we just have $10,000. But again, we're not going to put the number in right away. I'm going to begin cash balance. Name the cell so it's easier to grab too for later on. So I'll color it, and then I will do this, and it'll be $10,000. So we have the beginning cash balance in our assumptions table now. Let's go back to monthly cash flow statement and go to equals monthly or beginning cash balance. So we'll hit enter, and now it's there. Okay, so then what we're gonna do is gross sales, and the gross sales is just our revenue from the monthly income statement. So we'll go back, we'll hit equals, and then go back to revenue per month. We'll hit enter, and now we're done. Total receipts are just gonna equal this. Now this could be a little more complicated if we were becoming more complicated, but just in this instance, it's gonna just equal that. Then for gross expenses, all it is the total cost of goods, the total ad spend, and all those indirect costs that we've already calculated in the monthly income statement, just all summed up. So what we're going to do is hit equals, go back to monthly income statement. We're going to collect this cost of goods. We're going to add then the ad spend, and then we're also going to add our total indirect costs. So that's all summed. You can see there is our monthly gross expenses. Now, the one thing that's a little bit different in cash flow statements is that we want these numbers because they're expenses to be negative. So what I'm going to do actually is go here, and I'm going to hit parenthesis on both ends of this. And it's going to be a negative number because these are expenses. So we want them to show as negative numbers. We would do the same thing for amortization and depreciation and income tax paid because they're expenses again. But we're not going to worry about those two fields right now, or at least we're not going to even worry about them in this video. It's more just so you know, just aware of these two things. For total disbursements now, we're just going to hit sum, and it would be these three. And there we go. The net cash flow from operations is just going to be the sum of the total receipts plus the total disbursements. And that number, for at least for this first month, should add up to the same monthly income statement here, which adds up there. So that's great. Now, the one thing that we haven't included yet is this beginning cash balance, but we will in just a moment. Now, let's say we don't get any grants, we don't get any equity funding, whatever it might be, we don't get any of it. Now, here's where it gets fun. And now to calculate this ending cash balance is we take this beginning cash balance, we then add the net cash flow from operations, because this net cash flow is taking into account to how many sales we have, and it's also taking into account what all the expenses were. So we're going to add these two numbers, and that is what is left in the bank account. So in theory, if everything was right in our monthly income statement, and this is where our cash balance started, we'd still be okay because we have $5,000 left in the bank account. So we've done month one in this cash flow statement, but what we need to do is actually have this ending cash balance equal this cash balance up in February so that we can keep moving it forward. So what we'll do is have this equal that. So you can see that. So now ending cash balance just rolls over into February. So then I'll drag that over because that'll be consistent throughout. So you can see it's 0 because there's nothing here. For gross sales, all you have to do is then move this over as well because it's taking the same number over. So these numbers are going to be a little bit crazy. I'm not going to worry about too much. Okay, I'm going to drag this one over as well. I'm going to do the same thing for the next few. Just drag them all the way over. And we'll figure out the formatting in just a moment. So we'll drag them over. Okay. Then what we'll do here is that this is actually the same calculation, right? We don't have to worry about this month over month piece of it because it's just taking this and it's adding this. That's going to be consistent. So we actually can drag this one over as well. Okay. So then what we can do is just hit select all and then format the cells. And what we can do is just auto fit to column width. And you can see everything formatted really quickly, which is really nice. So you can see here's what's in the cash, like in the ending cash balance. Here's what's in the bank account every month. So that's really nice, because in this model right now, we can tell that we'd be okay. We're going to be profitable. We're going to be making money. We won't have to worry about closing up shop because we ran out of money. Now I'm going to just bold the ending cash balance and the beginning cash balance, because those are the two key numbers in this monthly cash flow statement. So we now have a monthly income statement, we have a monthly cash flow statement, we have our employees tab, and we even know how much traffic is coming to our website. This is telling us a lot. But what if you just want a more summarized version, a more annual type of look? Well, what we want to do actually now is create an annual income statement and an annual cash flow statement. And they're both pretty simple. We're going to start with the annual income statement. So the annual income statement here. And again, we'll type it up here. Now where it differs is that instead of it being just a monthly run, it's actually going to be years. So I'll do year. And what I'll do is 2023, 2024, and 2025, because that's the 3 years that we've calculated in this financial model. And you take it, all you're taking is these same fields that you have here. So what I'll do is actually just copy and paste them here. So I'll take this, copy and paste, and you can see I just borrow them all over. Now here is where it's really nice and really clever to have all these monthly looks and then roll them up into one annual income statement. All you have to do to get this revenue per year. So actually, I'll just change this to revenue because it's not per month anymore. It's on an annual basis. So to get that, all you have to do is hit equals the sum, and we'll go to 2023, and we will select all of the numbers in the year of 2023. So I'll click this, and I'll actually just click and drag all the way through. So there's that. I'll close the parenthesis, and there's all of our revenue for 2023. Now we do the same calculation for 2024. So I'll do the sum. I go to monthly income statement. I'm going to scroll over to get fully there. And I want this number right here. So we're going to do the same calculation for 2025 as well. But before we do that, I'm going to show you one little trick with these monthly income statements. You can see, right, if we scroll all the way to 2025, we lose what these numbers actually are, what the headings are, really. So what we want to do is actually freeze these panes. Now to do that, what I'm going to do is click on January 23. I'm going to go to view here, and I'm going to hit freeze panes. Now you can see here what it's doing is that it's freezing these first two columns and these first two rows because my cell I selected is here. So what it's doing, so now if I scroll over, it's keeping all of that together, which is really nice. So this is staying here even as I scroll. These are going to stay there. So you can do this the same thing with the monthly cash flow statement as well. So I'll do that right now. So I'll freeze that. And for this one, I actually don't want to freeze this monthly because I want to see which month it is. So I'll select this one. I'll select freeze panes. And now everything is really organized again, and we can still see what these actually are. So that's one nice trick that you should do with all of your financial models as well. Okay, let's go back to the annual income statement and calculate the revenue for 2025, which again is sum. We'll go to the monthly income statement, scroll over to 2025, and we will do the revenue for it. Okay, so there's all of our revenue, and we'll do the same thing for our cost of goods as well. So we'll do this. Monthly income statement, 23. There's 2024, and then we'll do 2025 here. So do sum, monthly income statement, scroll over. Here's all of our cost of goods for 2025. We'll just make sure, yep, that's right. Okay, so now we have our cost of goods. Now, one thing that's a clever little trick is that instead of us doing this for each one of these, you actually can just scroll all the way down because these are correlated. So this is the nice thing about us copying and pasting. This part of it is that they are aligned. So if I just do this, everything is calculated right away, and we just delete these because these aren't actually calculations. So The first way is we're just going to show you now we're all done. And we do the same thing here. So I'll do this. Actually, you got to drag from the formula field, so I'll do that. Do this. And then EBITDA, then we'll calculate in just a moment. We'll clean these up really quickly. And you can see that these formulas are right because ad spend should be $12,000 if we're not typing it and messing it up. So I'll just Control Z here. So actually what I need to do is just clear out here. So if you do mess up, all you got to do is Control Z, click out of it and hit undo and you're good to go. So there's that. I'm going to clear these out too. But you can see, we have in the assumptions and in the monthly income statement, we're spending $1,000 a month. So this aligns with what it should be. So that's just a quick check what we should be doing each time. Now for EBITDA, just to make sure that it is aligning, what we'll do is we'll do this really quickly. So it'll be the gross profit minus this ad spend minus this total indirect costs. And there is our EBITDA for each year. And all we have to do is drag that over. And we'll color that blue so it's consistent. So we'll do that. Wrong color, blue. All right. And now we have an annual income statement. So you can see here, in the year 2023, it should be a little over 300,000, $2.2 million, and then $8.4 million, and just these placeholder numbers. Okay, so that's kind of helpful in terms of what's happening from an annual income statement. Let's now build the last table we're going to build out, and that is the annual cash flow statement. So I'm going to create another table and name it annual cash flow statement. And do the same thing we've been doing and naming it up here. So there's that. And then just like we did with monthly income statement, I can do the same thing and just copy and paste these headings. So I'll do that. Go back to annual, copy and paste. And this is helpful again, because when we do that, when we do the calculations, they'll be consistent. So here is where the annual cash flow statement is slightly different than the annual income statement, because this cash balance isn't a sum of anything. It is the cash balance for the year of 2023, which in this case is actually that assumption that we put in a little bit before we made the monthly cash flow statement. So that would be the beginning cash balance that we have, that assumption. So we'll put that there. And then because we copied and pasted this, then we can do the same thing that we did for the annual income statement and just grab the first one, the sum of the gross sales of 2023 in the monthly cash flow statement. So we'll hit equals, I'll do the sum, and then go back to monthly cash flow statement and do the sum of the gross sales for 2023. And I'll close that out with a parenthesis. And then because we have this all the same, all I have to do is drag this down. And all of those numbers are then down here. So all the formulas are all correct and we should be good to go here. So there's that. We can keep those. We can get rid of these because those aren't actually formulas and these are just empty. Now let's do the same thing for 2024. So go to monthly cash flow. We'll go to 2024 here. 2024. Close it out. So Y8. So you can see here, you can also double check. So like N8 and Y8. So I'll go to monthly cash flow. So it should start at N8, which is right. And then we had, just because I forgot already, here's the Y8. So if we go to monthly cash flow, we go to Y8, and that is correct. Okay. So now let's just finish it up with 2025. So we'll do sum. And we'll go back to monthly cash flow. And then we'll go to this. So actually here, this is actually an important lesson. So now you can see, because I actually picked the wrong number. So if you see, if I drag and drop this here, these numbers are now off and they're calculating the wrong numbers. Like these don't make any sense. So what I'll do here is just kind of clear this out. So that's why it's important to make sure these are all lined up and you're grabbing the right numbers. So I'll hit equals sum and the gross sales of 2025. So which is this number here. That's the number I actually want. So I'll do that. And then now you can see actually, now if I drag and drop, these are right. So I'll clear these out. do this. So actually those we don't need to, because we want to keep those in case we do add those things in. And then this one should be all set here. But you can see this one's broken too. I picked the wrong number as well for this one. So I'll clear it out and we'll do it all over again. So 2024, go to monthly cash flow. Whoops, parenthesis can't be closed there. So actually I'll just close out of this, hit escape. So I'll do sum again, 2024. And I want to scroll over and do the gross sales there. So there's that. All right, and then I'll drag and drop this. Okay, so we are almost done with the annual cash flow statement, but there's one thing that's not right, and that is this ending cash balance. So once I'm going to clear these out really quickly, just kind of clean this up. And we're not for cash flow, for cash balance, right? It doesn't make any sense to actually have this be a summation because we don't need to know how much money like kind of came in and out of the bank account. It doesn't really tell us much, if anything. What we really want is what's the cash balance at the end of the year. So what we need to do for these is actually just go to the individual cells in the end of the years and beginning of the years for 2024 and 2025 and the end of 2023. So what I'll do is go to the ending cash balance for 2023, hit equal. So I'm going to clear that all out. Go to the monthly cash flow for 2023. I want the ending cash balance for the year, which is this number here. So I'll click on that. And now that's updated. Now that's right. So then beginning cash balance for 2024 will actually be the same number as this, but just I'll go back to monthly cash flow and just click on that. So there's that. And then I'll do the same thing I did for 2023, just going to the end of 2024. So which will be December and doing that. 2025 will be the beginning of 2025 or the end of 24. So that's this number. And you can see these numbers should always match in the cash flow statement, which they do. And then the end of 2025 will be this, 25. We now have the annual cash flow statement. We have the annual income statement, the monthly income statement, the monthly cash flow statement, the traffic detail, employees, and assumptions. Now, just for organization's sake, what I like to do is put annuals things first, monthlies next, and then other things last. So like you see traffic detail and employees last year. Now, here is where financial modeling is really powerful, and that is when you have to change assumptions. So let's say you want to see what happens. Let's say instead of traffic being, so you can see if we go to monthly cash flow, here's what's happening in the bank account right now. Like right now, we're safe. If all these assumptions are right, the business is okay. But let's say the traffic per blog post drops around 500, but it's actually maybe 100 to start out. So I change it to 100 in here. If I go back to monthly cash flow statement, you can see we're dead because these numbers went to negative. And if the bank account is negative, your business is dead, right? You can't continue operating if you don't have any money. So this is a really powerful tool because you can, again, simulate what your business can do if it hits these particular assumptions. And then the other thing you can do, right, is kind of see how powerful are these assumptions in this model, the way we've constructed it. So you can see, let's say, like maybe we do 300 instead of 100. Are we okay then? And then you can see here, it essentially breaks even pretty quickly from here. So we're doing okay here, but then you can see the business is doing okay. Now you can see how impactful, different things are at different times as well. So let's say like maybe this growth rate, maybe it's not 10%, maybe it's 5%. How does that impact things? So if I change that to 5, what happens to the monthly cash flow statement? Well, you can see we're still okay, and it doesn't impact it as dramatically as it did when we changed the monthly traffic for a blog post. You also can change the number of blog posts per month, right? Let's say you did 2 a week. Let's see what happens if you do that. Then you can see the numbers really dramatically increase really quickly. So that would be like, okay, we need to pump out more and more blogs if that's the case. So this is where creating a financial model is really powerful because you're not necessarily saying like, here's how much money we're going to make in these annual cash flow statements. Like these are kind of made up, but and these aren't, super accurate, but it's telling you that what this model is telling you is how your business operates. And the more and more you can just kind of continually to validate assumptions and figure out what's true, what's not, the more closer to accuracy you can predict how your business is going to do and what's actually driving the growth of where you want to go with your business. So that's where a financial model is really powerful. The last thing I want to cover in this financial model is that you can help predict, or at least see, if you need to do fundraising or any type of grant funding or anything like that within your business. So for example, let's say instead of this being the average traffic blog post being even like 500 or even 100, let's say it's 50, right? And the SEO growth rate is 5%. And let's say our employees, we're going to increase this dramatically. Let's say instead of like, it's going to be 1, we're going to drag this out, and then we're going to actually jump to 2 really quickly, right? And we're going to keep growing this team pretty dramatically. And maybe we do 3 here, right? So we just keep growing. So now it's getting pretty big. The numbers are getting bigger. But the nice thing, right, is that as we're altering these numbers, everything is changing in here. So if we go into monthly cash flow statement, we can see here that we actually need some funding in this part of it. And then do we need any funding as we grow? And actually, these numbers say no, but you can see the numbers kind of sway back and forth because we're adding headcount, we're adding different things. So if things do turn negative, let's say as you're growing and because you're ramped up growth or ramped up headcount in a particular time, you'll see numbers start dipping. So you can then predict whether or not you need to fundraise at particular times, or at least within certain windows, which is really helpful. Now, to add in finances, what you have to, like these financings, whether it's grants or equity crowdfunding or just angel investors or whatever it might be, all you have to do is add them to these financings here. So what we could do is, let's say you get a $10,000 grant here in the month of February. So we do $10,000, and it's not calculated here because we didn't add it as a sum. But we could do then, right, is then add the sum of these financings. You have to do this. We add the sum of these financings, and then we'll be good, right? And you can see all the numbers change really quickly. So then we just add that in case you add any like fundraising or whatnot later on. So you can see now the bank account is okay because we got a $10,000 fundraise. And because we've actually done the calculations here in this monthly piece of it, it rolls up into the annual cash flow statement as well. So if we did this right, so then what we could do then is the sum of these, just like we've done here. So if we do these, you can see there it is, and it's living there. So that is super nice that we have that. And we can just keep these actually too. So I'll actually keep these, and we'll build these out for 2024, for 2025. And we don't need these 6 cells because there's not actually calculations. But the nice thing, right, is that as we, maybe do another fundraising round, maybe it's like a long-term, maybe you get like a $50,000 grant or a loan. Now, if I go to annual cash flow, there it is in 2023. So that's really, really nice. And then you can see what's happening. You can see the full snapshot, these annual snapshots here, and they're all calculating back from these monthly income statement and monthly cash flow statements. So that is how to build a financial model for your startup. There's a lot to this video. If you have any questions, feel free to put questions down in the comments down below, and I'll do my best to answer them. If you found this video helpful, I would love it if you can give it a like, subscribe to the channel. If you're looking for other content similar to this on this channel, you can check out other videos like this one here.